New show of Market Makers. This is a show in which we'll debate, ideate, and discuss that what is the way forward for Indian markets now, considering that the global macro headwinds have only pronounced. Fed is committed to bring inflation down, but in this again war against inflation, are they likely to stomp growth? And if they are likely to stomp growth, will it hit India hard? We've outperformed very handsomely this year, but after this absolute and relative outperformance, could we be in for some time-wise and price-wise correction? Now, to answer these obvious questions, I've got a very special guest, Mark Mobius, a very dear friend and someone who needs no introduction whatsoever. Mark, I can see that you're joining this time from Cape Town.
That's right. Yes, I'm in lovely Cape Town. I'll be here for 1 week before going back to Dubai.
India is where the outperformance is, Mark. You should be in India, sitting in a studio in Mumbai.
I just emailed my analyst and said, I told them, look, we're underweight in India. Put more in India.
Are you underweight in India? And if you are, why are you underweight on India?
No, it's not actually underweight. I mean, if you look at the index, we're probably overweight from an index point of view. But of course, we're not investing according to the index. But we've got quite a lot in other, we're diversified. We're in Taiwan, we're in Vietnam, we're in many other countries, including here. We got one stock here in South Africa. So we're definitely bullish on India, no question about that.
In the current environment, when growth is precious and there are very few pockets of sustainable and visible growth, one of them is India, do you think it makes sense to have a diversified portfolio?
Yes, it does, because the problem when you have a very bullish environment, as you have now in India, is that the valuations go up. So the terrific bargains that you normally would want to find are not so plentiful. Whereas in countries which are sort of bombed out, I would say, like in Turkey or even here in South Africa, things are down a lot. There's pessimism. Brazil would be another example. So there are more opportunities, let's put it that way, more bargains.
Mark, India for the longest time has competed with China, both in terms of perception and also in terms of flows. Given that there is a change of policy, change of economic agenda, and the COVID problem, do you think money will continue to move out of China and it will benefit a market like India? So China is cheap. Chinese markets may have not given any returns from last 15 years, but do you think that story is unlikely to continue? Because every time investors have gone to China over India, they've only burned their hands.
Well, if you look at what's happened with the party Congress and the general change, there's a tremendous policy change taking place in China, where the idea of an open society is now not taking place to the degree that we expected. It'll be moving more towards a Maoist type of environment. The outlook for business is not going to be as good as it was in the past, when market forces were given a free rein. Whereas in India, the opposite is taking place. The government is opening up the market more. They're welcoming foreign investors. They're giving incentives for people to come in. So I believe we're seeing a sea change, a very, very significant change in the world, given the fact that India and China are the largest countries in the world in terms of population. We're moving into a shift, a historical shift towards India, which I think is very significant.
Mark, so what do you expect to hear from Fed later this week? Do you expect them to indicate 75 and a lot more, or 75 and no more?
I think they will continue to raise, but what the amounts are is the big question mark. But no question that inflation is persistently high, and they've got to do something about it. Despite the fact that oil prices have come down, they still have a very high inflation rate. And as you know, the playbook of the central banks is always to raise rates higher than the inflation rate, the CPI. So I expect inflation rates to continue at high levels, and of course interest rates to come up. The problem that the Fed has, and let's face it, the Fed is political in many ways, is the upcoming election, and they don't want to dampen the economy that would hurt the current administration. So they probably want to be very cautious about raising rates. But after that, after the election, things would change, I believe.
When you're investing into stocks, Mark, how much weightage do you give to Fed interest rates and macro?
We look at it, of course, we take into consideration, and of course, the stocks that we hold or buy will depend on how much debt they have, because with rising rates, you have a real problem with debt. If a country is going to continue to raise rates, then that means the companies holding debt are going to be in trouble. So we try to focus on companies with no debt or very little debt. And in that environment, these companies will do better than their competitors who have high debt.
Mark, you own 3 stocks, and you've been owning these 3 stocks for 3 years now. What is stopping you from making it 4?
We continue to look. We are searching for good opportunities, and that search will continue.
Let's talk about persistent systems. Since you've owned this stock for a while, it has done rather well. But given that what is happening to global IT stocks, the US tech stocks, and how there is a fear of recession, is it time now to hunker down your exposure to IT, and especially the name you own, Persistent Systems?
The changing environment globally is actually going to help tech companies going forward, particularly software companies, companies that are offering software packages that will help efficiency and decrease costs in companies. So I think Persistent is beautifully placed to play that role. And of course, people will begin to look more closely at what their costs are in software. And Persistent is able to compete very well in that space. In other words, lower cost and high grade software for companies in the mid-range, which is their target.
Is there a reason why you don't own TCS or Infosys or other popular names from the IT space? Because where you've invested 3 years ago is more like in mid-cap IT stock.
Yeah, our philosophy is not to hold index stocks. We want companies that are not in the index. So that leaves out these big names that you mentioned because they're index stocks.
Specific reason why you do not want to invest in index stocks, is that a philosophy which you apply to only Indian index stocks, or that's a global philosophy?
Well, it's a global philosophy that we have. And the reason why we do that is, first of all, our clients really have all the big names because they're investing in ETFs or index funds. So I'm not adding any value by giving them the same names, number one. Number two, these big index stocks have lots of research available. In other words, lots of information is there for everyone else to see. So there's no advantage to us in terms of research. Number three, the smaller you are, the possibility of the bigger you can get. Let's put it that way. In other words, it's better to start with something small that has a potential to become big. And of course, we look forward to the day that the index stocks include some of the stocks we now own. In other words, we'd like to see these stocks that we now have that are not in the index to eventually become part of the index. And of course, that will be a chance for us to sell.
Mark, the second stock you own is APL Apollo. And it's been a fantastic company. But given where commodity prices are moving, how do you see a pipe manufacturer stroke a company which is dependent on commodity prices really navigate this volatility?
Well, you know, interesting, if you look at commodities, and of course here in South Africa, I'm very much aware of what's happening to commodities. Commodity prices are actually leveling off and even coming down. Now, it's not a dramatic change, but I think we're at the point now where these commodity prices are not going to have a significant impact on people like APL Apollo. In fact, it will probably have a positive impact because the prices are leveling off or even going down. So I'm not too worried about that. In addition, APL Apollo has been able to increase prices in line with the increase in raw material costs. Of course, raw materials are just one small part of the total cost of the kinds of things they produce.
So, Mark, I know you own 3 stocks, and I'll have to jog my memory, and I remember 2 names. Can you help me out with the third name?
We're now involved in looking at new stocks in India that have more of an orientation towards consumer prices, consumer goods, and that sort of thing. And so we're in the process of selling down what we have in one area, but adding in the other. I can't add more than that, but that's generally the philosophy and the strategy.
So which is the name you're selling down, Mark? I'm taking the liberty of being slightly stock specific. We're meeting after Diwali, it's a new year, so I thought we'll make it special for our viewers.
I want to celebrate Diwali by not revealing the name.
So you can also wish Happy Diwali by telling us the name which you want to buy. Let me rephrase it the other way.
By the way, I saw some of the, there's a South African in India now who was celebrating Diwali because, as you know, there are quite a few people of Indian descent here in South Africa, and he was having a wonderful time in different parts of India. It was quite remarkable.
To invite you next year to celebrate Diwali with ET now on the streets of Mumbai in our studio. So let's fix that appointment. Mark, I'll go to a very basic question, and my very basic question is centered around how do you value markets when interest rates are moving higher? The way markets have historically valued market is it is a function of interest rates and cash flow. If interest rates are rising, how will that change the value orientation for growth stocks?
Well, there are various types of growth stocks. There are growth stocks that are in debt, that have tremendous sales growth, but are leveraged to the hilt. Then there are growth stocks that have no debt, which have a high return on capital and have no problem with cash. Those are the ones that we want to be in when interest rates are rising. One of the things you must remember is that the correlation between stock market performance and interest rates is very low. There are times when interest rates are high and the stock market is doing very well. And there are times when interest rates are high and the stock markets are not doing well. So I would say you have to be very careful in assuming that just because interest rates are going up, the stock market will be in trouble. One of the reasons why there's this lack of correlation is that very often the stock market will anticipate what the interest rates are going to be. So anticipating a high interest rate, stock markets at the beginning go down, but then it's realized by the market that, hey, high interest rates for good companies are not going to have a big impact. In fact, many of these companies that have low debt will begin to take over their competitors. And of course, their competitors with high debt will fall by the wayside. So you're going to make good money on those companies with the low leverage. So in that sense, we're not worried really about the high interest rates. What we're worried about is making sure that we have companies that don't have debt, that are not leveraged. And we see great opportunities now as a result of that.
Mark, you've not bought into consumer tech. You've not bought into manufacturing names in India. You've not bought into EV companies or auto companies. Is that the way you look at markets? Only look at companies which have no leverage and are cash flow dominated? Or you are not a big fan of the manufacturing sector in India or the EV opportunity of India?
We're interested in the manufacturing. There's no question about it. Hey, DL Apollo is one example. But we want companies that have this high return on capital and no leverage. And by the way, very often if you have a high ROA, high ROE, the debt will be low simply because they're generating so much cash, they don't need to be leveraged in any direction. And of course, you want earnings growth at the end of the day. That's really what it's all about. But the reason why we're not in a lot of these companies in India is because we haven't been able to find companies that meet those criteria. There's very few companies in the world that have a ROE of and ROA of over 20%. It's not easy to find, but those are the kinds of companies we want. But we're not biased against consumer, manufacturing, or any of these sectors. We're quite interested. In fact, we would love to have more of these names because the portfolio would be more diversified, but we just can't find them.
Markets in last 1 year have given absolutely no returns. I'm talking about the index. And in dollar terms, the returns actually have been negative. So if the starting point is 31st of October 2022, how much return do you think Indian markets can potentially generate from here on a 3-year CAGR basis?
I would say in dollar terms, you could probably get annualized returns of 5-6% for the entire market. But of course, for good companies, the returns would be much higher than that, within the mid-teens in dollar terms. So that's the kind of thing we're looking at going forward.
But Mark, will that make Indian markets not that attractive? If the risk-free return in the world currently is 4% plus, and when interest rates are rising, which means emerging market currencies like India will remain under pressure. So if you expect Indian markets to generate 5-6% return in dollar terms, then investing into India from a global investor perspective may not be a great idea.
Well, don't forget now that 4-5-6% that I mentioned includes the devaluation prospects of the rupee. And I think a lot of the devaluation against the dollar has already happened. It's probably not going to go that much further, particularly with the plans to raise interest rates. As you know, the RBI is thinking of raising rates in India. So I'm taking that into consideration. You must remember, as I mentioned, devaluation of the currency does not necessarily mean that you're going to have a bad return in dollar terms, because you've got companies that are exporting and getting dollars, and their returns in dollars are very good as a result of that.
Mark, which is one trade which, if I insist, if you have to define for next 1 year, whether it is bond or commodities, whether it is Bitcoin or whether it is dollar index, what is that one trade which you would say it is not a multi-year investment, but it is a short to a medium-term trade? What is that trade for you?
I would probably have to say India and not the US. The US has already done quite well, but it's coming down. Bitcoin will follow the US market, or will lead the US market. But if you have to be very specific and pinpoint one area, it's probably going to be India. And the reason why I say that is it's a huge market, of course, but what's happening in China is having a very big impact on India. More and more manufacturers are moving to India. You're going to see, up to now, it's been software exports from India. Now you're going to see hardware exports from India. And this is going to be very positive for the entire economy. And of course, then you've got this vast consumer market, which is becoming richer and richer. So that is going to be a big plus as well.
If you're bullish on India, why are you shying away from financials? Because financials is the biggest proxy to any country. In India, the retail credit is strong, corporate credit is making a comeback, the balance sheets of financials, at least banks, they are looking solid. So why are you giving the largest sector in India a skip?
The reason is, first of all, most of these banks are in the index, the big banks, okay? That's number one. Number two, banks generally, particularly when you go beyond With the big banks, to some degree, you can trust what they tell you. But when you go down the scope, and by the way, this is not only about India, but around the world, the transparency is very bad. Because if you ask a bank, please give me your client list, give me a list of your outstanding loans, etc., they won't give it to you. So it's very difficult to know what the bad loan ratios look like, which is very critical when you're looking at banks. So that's really the reason why we've shied away. It's not a hard and fast rule. We find the bank that is not in the index, that is very transparent and doing well, by all means we will want to buy it.
In your previous avatar, you bought into PSU stocks, and that was not a very happy investing experience for you. But looking at the renewed vigor in some of the PSUs, whether it is PSU banks, PSU defense, or some PSU manufacturing names, would you be tempted to look at Indian PSU stocks?
Probably not, because of the management difficulties that you have in those types of companies. We prefer companies that have a strong entrepreneurial bent, companies that are very privately run, and there's much, the entrepreneurship is really the key when you get down to the growth in business. If you look at all the companies that have been growing very rapidly, they're usually very entrepreneurial. And this is something that you don't get in that category.
Mark Mobius, last time when we spoke to you, you said you're 80 years. And when I tweeted about your age, everybody wants to know that what is the secret here? How does Mark, who's 80 years, still look 60?
Well, it's try to keep happy, number one. Travel, I love to travel. And exercise every day. You've got to be on that bicycle at least a half an hour in the morning and do some weight training if you can, find the time. I would love to do something about my diet, but I have a ravenous appetite for lots of things that I shouldn't be eating. But anyway, I think you got to watch your diet as well to some extent, particularly as you get older. You may want to do some fasting, which is a good idea from time to time. But that's really, I think, hopefully the secret. I don't know whether that's a secret or not. It's well known.
Buffett made 99% of its wealth after he turned 60. Is Mark Mobius thinking on those lines?
Yes, definitely. I want to continue. I love what I do. I love the work. I love to talk to people like you. Find it very interesting. And I think that's what keeps me going.
In the movie Wall Street, Gordon Gekko says this very famous line that every man is chasing a number. So what is the number Mark Mobius is chasing? $1 billion, 2 billion, 5 billion?
Right now, because we started all over again, since I left Franklin Templeton, we started from the bottom, which was a big challenge and lots of fun. Now we're looking at about 2 billion. We got a long way to go.
Really appreciate your time. And as long as you're investing in good quality Indian companies, I'm sure the happiness quotient of your life as an investor will be taken care of, because India is where the real differentiation of the economy is, and this is where the real growth is in today's anemic world.
Yes, definitely.
All right, that was Mark Mobius. It's always inspiring to really understand that he's invested in 3 stocks, disciplined, not only in his personal life, but also when it comes to his investment portfolio, sticks to what he understands. So no banks, no fintech, no startup stocks, no consumer tech. You lose less, you may gain less, but if you lose more, trust me, over a long period, by protecting your capital and by multiplying it consistently, the returns are going to be really on the top quartile. That is what Mark Mobius has done over the years. He's called many bubbles correct in the past, and he's called many booms correct in the past, and he continues to believe that Indian markets have a long, long way to go. Let's take a break.